Do I have to pay back my policy loans with IUL, otherwise known as Indexed Universal Life? Welcome, my name is Daniel McCluskey. I'm an industrial engineering graduate from the University of Illinois with a track in econ and finance, turned entrepreneur dedicated to helping you take the stress out of your finances so you can focus on what matters most to you. A lot of people, as they're diving deeper into the nuances of IUL, pose the question that we're going to go over today, and that is, I'm starting to consider this, I really like this, but these policy loans, they kind of rub me the wrong way, especially that term. Am I gonna have to pay those back? Let's get into that now. So we're going to hit on three topics. The first one being what happens if it's a fixed/zero wash loan? Am I gonna have to pay that back? The second case is what about if it's a variable loan? Will I have to pay that back? And then third, if I have a loan balance on either of those two, what happens to that when I pass away? So if I have a death benefit, is that full thing still gonna pay out to my heirs? How does that work? First, we have our fixed, or sometimes called zero wash loans. Essentially what these are is, let's say you have a cash value of around $500,000. You wanna take $50,000 of that money out of the policy through a fixed loan. Now, before we go any farther, one thing to note here is sometimes people use these terms fixed and zero wash interchangeably. Sometimes in the early years of a policy, they're not going to offer a zero wash loan, but they will offer a fixed. What this is essentially saying, I'm going to take out this $50,000 at a fixed rate. Let's call it 3%. A zero wash loan would be, okay, you're going to take it out at 3%, but the insurance company is going to guarantee that same money, they're going to put it in an account that's gaining 3%. So even though you're loaning at 3%, it's still gaining 3% over here, so it's kind of a wash. That's why it's called zero wash. In the early years, sometimes you'll have to take it out at 3 and they'll only credit you 2.5, so you might be losing a small spread. It depends by which company you're with, but usually these zero wash aren't going to be allowed until some later years in the policy. So you had the $500,000 in cash value, you loaned out $50,000 using a fixed or zero wash loan, it doesn't really matter. Now the question comes, do I have to pay that back? In this case, the simple answer is no, you don't. Reason being, let's just say it's the zero wash loan, even though you're loaning that money at 3%, that $50,000, and you let that grow for 50 years of interest, that whole time, that same $50,000 was also growing in your account at 3%. Therefore, there's enough to cover that loan. You're never just gonna have to pay that off. So all of that money that you loaned out, even if it was just the $50,000, came out as a tax-free policy loan. Why? Because you didn't realize any gains. It's a loan and it's done within the confines of a life insurance policy. Hence, it's not considered an investment, and that's where the tax-free side of things comes from. So fixed or zero wash loan, do you have to pay it back? No, you do not, even if it's gaining interest. Second is variable loans. So essentially what these are, and the reason why people will go with them, is the insurance company will generally set a cap for them. So they're gonna say, we're gonna give you a variable loan rate. It could change, hence the term variable, but it's going to cap at, let's say, 5%. So what people will do is they have the $500,000 in cash value, they have $50,000 they want to take out. They're going to loan that money at a variable rate that caps at 5. Why would they do that when they could just do a zero wash loan? Let's say it's in the later years. Reason being, they're going to pull this $50,000 out at the variable rate. Let's just say it hits the cap every year and it's 5% indefinitely, right? They pull that money out. They're gonna go spend that. Maybe they're gonna put it in some sort of investment. Maybe they're gonna put it in their kid's college. Wherever they wanna use that money, they can. The idea is this same $50,000, they're going to keep it in the index, hopefully earning, in theory, higher than 5%. So the loan you're paying 5% on, but that same money is gaining, let's just say 7%. If that's the case, well then you have money that, let's say you pulled out for retirement and spent, still making you money. So it's money you've already taken out, you've already spent it, and you're still getting a 2% spread in this case on that money. That's why someone would use a variable rate. So even if, let's say you pulled out the $50,000, it's growing at 5%, would you have to pay that back? The answer is no. Why? Because it's still staying in the indexed account, in theory, growing higher than 5%. Now, if you pulled that out at 5% and you kept the money linked to the index, and in theory, that same money did 0%, so the index went down for 20 years in a row, and this kept compounding at 5%, in theory, you would have to put additional money in to cover that loan balance. However, I don't really know how realistic that is. You can make that judgment for yourself. So there you have it. You have our fixed and zero wash loans. Do we have to pay those back? The answer is no. We have our variable loans. Why would people even use one of those? We've gone over that. Would they have to pay them back? The answer is no. Lastly, well, what if I have this big loan balance? Let's just say it's built up to a loan balance of $200,000. You have a death benefit of, let's just call it $1 million. So you had 500 in cash value. You have $1 million in death benefit, and then I pass away. Well, what happens to this loan balance? I know my death benefit was $1 million, but I also had a loan of $200,000. What's going to happen? It's very simple. The reason that it's able to stay tax-free, and it's not some sort of money that you pull out tax-free but then gets taxed when you die and it's a problem for your heirs, it's actually that when you pass away, that $1 million, that death benefit that's going to pay out in full, tax-free to your beneficiary, they use part of that to cover whatever the loan balance is. So if they had $1 million death benefit, it's going to, instead of just paying it straight to the beneficiary, it's going to say, what's your loan balance? Okay, it's $200,000. We're going to take this $1 million, we're going to take $200,000 from it, pay off the loan. Now there's $800,000 left. That's going to go to your beneficiary, tax-free. Why? Because it's life insurance. And that is really the backbone of how the tax-free access in IULs works, is because even though you're taking a loan and that's gaining interest, when you pass away, all that happens is that loan balance is going to subtract itself from the death benefit. Why? Because in the case of, let's just go back to you had 500,000 in cash value and you loaned out 50,000. So let's say you loaned it out. The second you loaned that out, you passed away. Well, if the death benefit was $1 million and they paid out the full $1 million, well, you just withdrew 50,000 that's going to pass on to them in a trust or a will or however, and then now they're paying them the full $1 million. They're not going to double pay you for, hey, you took it out in a loan and we're not going to change the death benefit. That would be ridiculous. So the reason is they subtract it from the death benefit so they're not double paying you. So there you have it. Fixed loans, variable loans, you're not going to have to pay those back. You can if you would like to. And then when you pass away, all that's going to happen is the death benefit is going to cover that loan balance and the rest will go to your beneficiary tax-free. Hopefully this was helpful. If it was, be sure to subscribe. And if you are starting to wonder how you can bring some peace into your own financial situation, feel free to book a free 20-minute quick consult with me to dive more into your specific scenario. The link for that is always in the description, and I will see you in the next video. Bye-bye.